Welcome everyone, thank you for joining. My name's Stephanie Parker. I work at the Department for Business, Energy and Industrial Strategy, and I head up a team looking at the decarbonisation of non-domestic buildings. So I'll be chairing today. Thank you very much, first of all, to CREFC and BPF for asking me to chair today, and also for inviting our excellent panellists. We're going to run a couple of polls through the session. We've got the opportunity for you to ask questions, but please do that through the Q&A function rather than the chat, because that's much easier for us to handle. And I'll just briefly introduce our panel members. They can say a little bit more when they answer the first question. So we've got Joe Holden today. She's the Sustainability Director at Peel L&P. We've got Daniel Chang, who's the Managing Director at Hines UK Limited. We've got David Willock, Managing Director, Head of ESG Finance at Lloyds Bank, and Gregor Bammet, Head of Real Estate Debt at Aviva Investors. So thank you very much for the panelists. So as you know, lenders and investors are increasingly focused on the challenge of retrofitting the UK's commercial property to meet the government's net zero targets. And the government is currently consulting on both EPC B for commercial industrial rented properties and the potential introduction of performance-based ratings for larger commercial buildings. So today we're going to talk through a number of questions on that topic, and we hope that you find that the conversation is interesting. I'm really looking forward to it. So without any further introductions, I'm going to move on to asking the first question. So if I can ask Joe first, what are the specific areas of focus for real estate firms looking to improve the climate sustainability aspects of their existing buildings, and how are they funding those improvements? Thanks, Joe.
Great, thanks, Steph. Morning, everybody. I'm Joe Holden. I'm the Director of Sustainability and ESG for Peel Land and Property. We're a large regeneration business based in the Northwest with lots of waterfront mixed real estate assets between Glasgow, Liverpool, Wirral, Kent, and also we develop Media City in Salford, Greater Manchester. So that's a bit of background about me. In terms of what's happening in sort of the landscape of climate resilience at the moment, I think it's very much not just about individual buildings, but it's about whole neighbourhoods and how we can make all of our neighbourhoods more climate resilient within our placemaking activities. So traditionally, I think within existing buildings, that meant starting with energy efficiency in retrofit projects. But it just means so much more than that now, much more than, energy is absolutely the right starting point, but it means so much more in terms of the overall climate resilience for an existing asset. So one of the things we're concentrating on at the moment is actually conducting climate risk assessments for 25 of our assets. And then looking at the climate resilience of those assets over the next 10 years and the next 50 years and beyond 50 years as well. And then creating action plans so that we can reduce the physical risks that are going to challenge us due to climate change over time. In terms of how we're funding that, yes, well, we're just sort of traditional routes of funding at the moment. Some of the activities can go onto the service charge for the buildings, and other activities are through the regular sort of capex route through our revolving credit facilities and loan facilities. So nothing special there. Except we would like to start linking sort of ESG linked loans to these types of activities in the future, because there's a massive overall benefit for the assets themselves and the surrounding communities by investing more in climate resilience.
Thanks, Joe. Daniel.
Thanks, Stephanie. Thanks, Joe. Good morning, everyone. My name is Daniel Chang, and I'm a Managing Director at Hines within the Portfolio Management team. And I also wear another hat where I cover the ESG strategies for several of our European investment vehicles. And so that includes core vehicles as well as value-add refurbishment vehicles. And so to the question of what we're looking to improve in terms of climate sustainability aspects, I think as some of the things that Joanne has mentioned, we focus on the broad spectrum of ESG But that entails many different things. And so in terms of the E side of it, it really does focus on being much more energy performant and reducing energy consumption on the operational side, as well as on the design side and on the embedded carbon side. In terms of the S side, it also includes really engaging with our different stakeholders in terms of whether that's our tenants, whether that's our investors, and very importantly also with the communities in which we are invested in. And then finally on the G side, we're also really about making sure that we are inherently being explicit about the risks of climate risk to all of those stakeholders as well. And in terms of how we approach the financing of those different initiatives, it really depends on the strategy. I think for core assets, existing buildings, for example, we, first and foremost would look at things that, that have to do with really optimizing the operational aspects of the building and having a very comprehensive energy monitoring program, for example. And that's something that we would finance through operating income, net operating income. When it then goes on those same existing assets to sustainability features, we would typically finance those through equity, although we do have debt facilities, but they're more on the actual building rather than on the CapEx related to sustainability. Now, if you go to the other risk spectrum of development buildings and refurbishment buildings, there we would have debt facilities related to the construction and refurbishment projects. And so those would incorporate within those business plans ESG criteria, which is very, very important. And so those would be financed by lenders. And so, as Joanna said, I think we have had a lot of very positive experience with green financing, especially in recent years, although I think there's definitely a lot more that we're hoping that we can do in that front.
Oh, thanks, Daniel. David.
Hi, good morning, everybody. My name is David Willock. I'm Managing Director, Head of ESG Finance at Lloyds. So just without going over old ground here, I sort of see it in 4 levels. So the first level is really around the low-hanging fruit. So the sub 5-year payback. So we see most people looking at that the easy wins. I think sort of dropping down a level, what we're seeing is people take advantage of the natural moments when they're engaging with their building. So this is when the building's getting opened up, it's a lease event, it's vacant, and we're seeing people look to optimize with a sort of more sustainability lens. So rather than just doing the basic requirements, going a bit further with some slightly different objectives. I think what we're then seeing, and Daniel touched on this, more and more people are looking at the whole life carbon, so embodied carbon, the development process, but also the refurbishment and ultimately demolish or repositioning focus. And Steph, you mentioned about in-use performance. We're seeing more and more people looking at, what happens when this building is occupied? How do we assist our customers and our clients to really use the building in the way it's been designed and optimizing that? And I think at the real exemplar end, we're looking at people about self-generation as close as possible to the asset itself. We're looking at energy sources, but also beyond carbon and energy, wider resource management and circularity, but biodiversity and net gain, and actually ultimately long-term resilience. What is going to happen in 20 years, 30 years time to this asset if some of these scenarios play out? So there's sort of those 4 levels of complexity that we see playing out.
I don't know if David would and Daniel would concur, but often it's all about the refurbishment cycle and what you can do when as well. There are lots of things you can do in the background, but in terms of the actual practical changes you can make to the real assets, you really have to sort of be able to program that in over time, because you may only have a chance every 10 years or 15 years to make that really big significant step change.
Gregor, do you want to come in there then?
Sure. Thank you very much, Stephanie. And good morning, everybody. I'm Gregor Bammert. I look after the real estate debt business at Aviva Investors. We manage just over £8 billion of debt secured by mostly commercial buildings across the UK and Europe on behalf of a range of investors. I think the key points have already been made. I think the one area I'd say about where we're seeing activity is it's about taking the conversation beyond what a landlord is doing to a specific building, and more around the broader stakeholder. How are they interacting? How are the people who are actually using that building on a day-to-day basis, whether that is the tenants or other use, and really building a more holistic strategy. That's kind of where we're seeing very much the best-in-class operation. In terms of financing, I think what Joe and Daniel have flagged is, I think, exactly one of the challenges for the industry, in that there aren't necessarily dedicated funding pools available, and that puts people in the situation where they're saying, okay, I'm either going to spend money on this or I'm going to have to spend it on somewhere else. And I think that's where, as an industry, we can come together, and I know a number of initiatives are out there to ensure that actually the overall financing package for buildings, for portfolios, for companies is much more aligned to focusing on this, and that you don't have to have that sort of it's either one or the other focus.
Thanks, everyone. That's really interesting and a great opener. I've got a question around minimum regulatory requirements, which I think we've already touched on, in terms of whether organisations are struggling with those minimum energy efficiency, for example, standards, or whether there's a higher level of ambition.
Yes, well, I can take that one if you like, Steph. I think it is for a lot of business now, especially, let's say, the larger businesses, it's very much more than just meeting regulatory requirements. And we have to stay ahead of the game. We have to look at, be very, very wary of stranding our assets as well. We've got COP26 coming up. We've got very, challenging targets coming through from the Prime Minister, and so in terms of, it's not easy. It's not easy to become net zero carbon by 2050. For those of us on the ground, it is a real challenge, and so for us, the journey started sort of in 2014, when we really started to dig deep and measure our energy use. And therefore we started off on the route of the ISO 50001 energy management system, which means now we've got a very mature system in place, which puts us in a good position to look at being net zero carbon. And we've now got 16 buildings verified as net zero carbon against the UK Green Building Council's definition of net zero carbon. So yes, people will be in different stages of that journey, but I think a lot of real estate sector will have these higher levels of ambition for science-based targets, for net zero carbon, and also very, very conscious of one eye on where their assets are going to be in 10 years, in 20 years, in 30 years, and making sure that they're fit for purpose for their occupiers at that time.
Yeah, I just pick up on something Joe mentioned there about people being on different parts of the journey. So if I go back to 2016, when we launched our green lending initiative, I used to sort of say it's more like a normal distribution curve. There was very few exemplars who were really pushing that agenda. There was like a big bit in the middle that kind of like some people were kind of interested in doing stuff. Some were probably were varying on the not doing much or doing the minimum. And actually there was a whole heap of investors and developers that they didn't felt that it applied to them, or it wasn't important, it wasn't a priority. I think if we fast forward to now, that dynamic, that curve is materially changed. I think if we look at the minimum energy efficient standards, it kind of talks to that carrot and stick, that applies across many parts of life. And actually it worked. It brought a lot of people that weren't into that conversation or doing stuff to action. But I think going forward, I think Steph, you mentioned, EPCs has its fans, it has its detractors, and lots of people talk about the performance gap. So I think we all need to keep a really close eye on what happens with regulation moving forward, because it clearly is a lever that can be pulled to help direct markets in a certain way, and particularly the real estate market.
Thanks, David. That was good to hear from a government perspective. So our next question is around risk. To what extent is climate sustainability and risk, including transitional and regulatory risk, reflected in the price of buildings and/or the rental price?
I'll take that one, Stephanie. I think from our perspective, there's a very strong correlation between ESG performance and pricing and value and rental values as well. I think it is a difficult thing to pinpoint exactly how much. I think it's more about talking about a green premium or a brown discount. But one of the things that I also do in my role is manage the valuation process every quarter for our core fund. And having engaged with the valuers, it's very difficult to extract exactly what the value is for ESG criteria. Although I know that in the valuer community, that is something that they are focusing on more and more. And I know that some of the valuation teams are incorporating in their teams people with an ESG background. And I do think that that is something that they're going to be sharpening their focus on going forward more and more, so that potentially there will be something that we can then point to in terms of how that is being incorporated mathematically or analytically. But again, there is a strong correlation, and we've seen, for example, for one of the funds that I work on, the Heinz Pan-European Core Fund, where that fund has been sector leader for the last 3 years in its peer group. And at the same time, it's also achieved the MSCI Top Performance Award, performing 211 bips above the average benchmark from 2017 and 2019. And that kind of coincides as well with the period that we've outperformed in the GRES benchmark. And so I think that it is definitely something that is related and you can talk about, because I think that ESG more and more is a way to future-proof, and it's a way of talking about quality of your assets and of your portfolios. I think on the rental side, it's maybe a little bit more transparent in the sense that if you are managing your buildings very efficiently, you're able to reduce part of the rental package, which is the operating expenses. And so if you can pinpoint how much you've reduced the operating aspects of the service charges, and you can demonstrate that to your tenants, then you could also negotiate more easily a higher rent. And then as a whole, that would achieve a higher nominal rent, which would then influence when it's valued a higher valuation. But all of this is that part of it really needs to be demonstrated, and you need to have that negotiation with your tenants.
And maybe if just to add to that, I completely agree with what Daniel said. I think the correlation is clear in terms of actually buying and selling a building, but we're not necessarily seeing that coming out in valuations. And part of that is because valuation methodologies are a bit backward looking. You look at past rental evidence, you look at past transaction evidence, and you use that to base your valuation metrics. But through that, you're also looking at past rationales for buying a building. When we're talking to our clients about funding and acquisition, they will always have a very important focus on ESG. That doesn't mean they're just buying buildings that are already green. They absolutely could be buying assets that need a transition, but the underwriting will factor that into their overall assessment of that building. But when we then get a red book valuation, the differentiation isn't sufficiently strong on that front. So we definitely think that there is more work to do in that area. And I think also, just to add to what Daniel said on the rental side, it's not just about the pounds per square foot differentials. We see clear evidence that more efficient buildings let up more quickly, so your void periods are clearly less. And for many of the highest quality tenants who you might want in your building, if the right features are not there, there is no lease to be signed. It's not a question of a few pounds more or less on the rent, they won't sign up. So there definitely is clear correlation there.
Thanks, Gregor. I think what you said in part of your answer to that leads nicely on to a next question, which is around are lenders providing the kind of support borrowers need to retrofit existing buildings, or is there too much focus on new build? And there was also a question from the audience, which is around how can we separate normal purchase borrowing with retrofit borrowing? Can loan to values be increased for that specific purpose? So it's quite a lot to have a go out there. Sorry.
Okay. I'll just pick up two bits quickly, and then we'll go from there, because like you said, there's quite a lot in that. So we have seen evidence in the Dutch market where there's been differentiated approaches to loan to value based on some of this stuff to facilitate the sort of retrofit financing. Having looked at this personally, there's actually, as most of the audience will know, there's quite a lot of complexity in execution of both legal and property security. So what we fundamentally need to really accelerate decarbonisation and retrofitting is all the plumbing that sits behind things, including lending products, to actually accelerate this on a significant basis. So it's certainly something we're looking at. And I know, Gregor, obviously you got their proposition, but sustainability linked loans, for example, it I believe is a huge opportunity for us to focus on decarbonisation of existing stock, because whoever asked the question is right. It's great that more and more green assets and green loans and green bonds are being created, and hopefully more and more of those qualifying collateral exist going forward as the benchmark increases. However, we've got to deal with the existing stock. It is the big, the big part of the market. And yeah, we need to get qualifying products, but what you will see is potentially, as more and more analysis is done on the forward-looking risks, is actually you might see adjustment go the other way in terms of appetite might reduce for those that can't decarbonize. So you might get higher LTV for those assets that can demonstrate a pathway to a more sustainable sort of future in terms of value and income.
Thanks, David. Does anyone else want to come in on that? Gregor, perhaps?
Yeah, sure. I think we are making progress in this area. I think there is more focus, as I touched on before. I think we're not yet seeing the impact reflected in value. And as David said, that's a two-way piece. We don't think that the transition risks for some assets are fully captured within buildings. And very clearly, what as an industry and in terms of a lending industry, I think we need to get clearer at is how do we make sure our financing is tied and adjusted to the actual plan. So would you, and in a very simplistic basis, I think if somebody came to David or I and said, we've got a building here which is kind of currently not efficient, needs considerable amount of money spent on to retrofit it, but we haven't got a plan to do that, that's a pretty short conversation from a lending perspective. Whereas if somebody says, right, I've bought this asset, I think it's a huge opportunity, here's my 3-year plan, this is what we're going to do, that starts to become quite interesting. And at the moment, there's far too much focus of, well, what's the loan to value on that loan? Well, the first loan is possibly a bad idea at any LTV, but it's clearly a more risky proposition. Whereas the second one is something that could be, with right framework and protections, quite interesting.
I think now might be a good time to look at the results from the first poll. Oh, that was very quick. I wonder, David, would you like to reflect on the results of this poll, which is...
Yeah, sure. So I can't look at the screen and look at the results at the same time, but what really jumped out to me straight away was obviously the lead, right? Stakeholders. And as Joanne sort of referenced a bit earlier on, the classic scenario that comes up in real estate is the agency issue, the split incentive, the tenants and the landlords, oh, I can't possibly do it because the tenant's in there. And yeah, there are deep reasons why that can't happen. But, I work across other sectors, and actually what we're seeing is this groundswell of tenants who are there saying, hang on a minute, I've got a net zero target. I've got to get hold of my own operations here. So I think that will change, but it's easy for me to say, all of you that manage and own properties, these are deeply complicated things to get moving forward, the negotiations and actually the physical delivery. I was cheered briefly to see that finance wasn't the leader in terms of the barriers, but I'll pass over to others to see if there's any observations that jump out.
I had a similar reaction. I was surprised as well to see that stakeholders was on the top of the responses. I agree with the discussion that the whole coordination with tenants is a hurdle, even though they are more and more very interested in aligning with their own corporate social responsibility strategies. Obviously, that split incentive in terms of putting in the capex and then who pays for it and so forth is always an issue. But on the other side of it, and this is maybe something we'll talk about later, is I do find that the investor community, especially the institutional investors, are very much focused on driving a lot of the ESG criteria and performance. And we see that in terms of just the level of due diligences and the granularity with which they approach investing with different investment managers. So it was actually interesting and surprising.
And I can see that the government's role there comes up in terms of clarity about future regulation. So obviously that's something that my team's looking at, and we've got our 2 consultations out at the moment, and are also thinking about policy relating to the remaining kind of chunk of the stock, which is the smaller owner-occupied buildings. So we are working on that through the heat and building strategy and our policy work at the moment. So fingers crossed that everyone can respond to the consultations that we've put out, because that's incredibly helpful.
Steph,
David.
just on my travels, I've seen some sort of varying awareness of particularly the EPC trajectory. Could you just for the audience, like sum up a tiny bit of what's being talked about in terms of the levels and the timeframes, just so everyone's aware?
Yeah, sure. So in the energy white paper, we confirmed that we would tighten the trajectory to EPC B by 2030. So that is the government's intention. We need to regulate, so we have to put some legislation through Parliament, but we hope to do that early 2022. The policy still has kind of things within it like the payback test and space for exemptions. So through that policy, we don't expect every building to get to EPC B. We know that's not necessarily possible, but yeah, we do think that will bite on about 85% of the rental stock. That regulation will mean that 85% has to consider what they're going to do to get to EPC B. We also know when we originally consulted that people raised very legitimate concerns about the enforcement and implementation of that. So that's the consultation that's out at the moment. It's not actually about EPC B, it's about how we enforce that and how we implement it. So we're proposing kind of enforcement windows and a clearer role for local authorities. So yeah, there's quite a lot of detail in that policy, but yeah, do have a look, and I'm sure we can share the links to those consultations as a follow-up to this. That we'll move on to question 5, which I think we've touched on, but I think again will be interesting to look at the specifics. So when will investors stop buying buildings or lenders stop lending against buildings in the absence of a clear strategy? I mean, Gregor, you mentioned that might already be the position for some people, but anyone else got any more detail that they want to add that? And I would say this is quite interesting from my point of view, because this is some of the early feedback we've had on our performance-based ratings proposals around if it becomes much more transparent which buildings are not particularly energy efficient or net zero ready, will that kind of drive faster behaviour in terms of people not being so keen to invest or lend against those assets? So great to hear people's thoughts on that.
Sure, I'll just jump in and continue sort of from the previous comment about investors. And I think that investors are, especially institutional investors, are keen to understand that investment managers will have an ESG approach to their strategies more and more so. And it's not just about box ticking. They really want to then follow up and understand what has been done over time and monitor that progress. And I think for core assets, that may be one thing, that you can buy assets that already have ESG credentials, but also for refurbishment and development and repositioning strategies, you can buy an opportunity that may not be green today, as long as you can show that you will be doing something with an ESG strategy, as Gregor was mentioning before. And I think that's really important. And I think in order to do that convincingly, I think the transparency around the risks related to certain things that, in terms of, whether a building may be linked to gas or something that will make it more difficult for it to become fully green, is something that is important in terms of understanding and underwriting that risk in the business proposal. And so that transparency will definitely help in terms of identifying those risks and making sure that people can then take those strategies forward.
We've got a related couple of questions. So one from the audience around and this is quite a technical question, I think. What is the typical benchmark costs for greening a brown building? Does anyone have any thoughts on that? And I guess linked to the earlier question, what do people think will happen to buildings that cannot profitably be adapted to meet the climate targets, and how, this is a particular interest of government, how should we deal with places that will be most affected?
I'll come in on that one, Steph. I think it's so dependent on the individual assets and the age of the asset. And for example, we have several assets that are about 30 years old. So it's looking at the technology that's within those assets at the moment, and then how we can decarbonise that through refurbishment. So one of our recent refurbishments at Salford Quays, a building called the Vic. It's a £9 million refurbishment, and we spent over £1 million on the new energy technology for that building. So the benefit of that is now that, absolutely to do with the running costs of the building have totally gone through the floor. And now there's a sort of a reduction of 70% in our carbon emissions and energy use from that building. I mean, that's obviously at one end of the scale, and it was, again, timing was right for the refurbishment cycle. We're always looking ahead to what technology's out there, and that can be a little bit vague at times about what is the right technology now. And what's the most cost effective as well. And so in terms of heat pumps, that's more heat pumps coming through, but it can be very expensive. And also looking at water intake. We just had a study looking at water intake to our building for cooling, which is from our docks. So that seems a very cost-effective way of doing it. But then if you apply a climate risk assessment to that, the temperature of the water will increase over time, which then affects the rate of cooling for the building. So yes, it certainly does get quite technical. But even so, in terms of what we're doing and our targets, I think we will still keep pushing the envelope on it because of our occupiers. So regardless of sort of targets, it's about meeting the demands of our occupiers, and that continuing to be a significant driver. So if we can keep attracting occupiers to our buildings, we will keep upgrading the buildings to make sure that the people are comfortable within the buildings and in the public realm and the surroundings. And then if we've got fully let buildings, then there's the opportunity to keep making a profit, which we need to do. So I think it is certainly about targets, but it's a much wider drivers in terms of ESG, the community, your occupiers, how that all fits together to keep looking ahead and making your buildings fit for purpose.
Thanks, Joe. Has anyone else got any thoughts on perhaps the more difficult buildings and the places that might be affected by those?
So I think one observation, and particularly in the way the question, one of the questions was phrased, was around, profitably retrofitting an answer. So profitably retrofitting a building, and I think maybe the lens on that needs to change slightly. It's not about, do I invest 10 and get more than 10 back? It is also defensive, because if I don't invest, what is that building going to be like? So in some cases, investing 10 and getting back no more than 10, but keeping some degree of value, is that is the profitable return. So I think it's really about comparing not just what is the return on the capital invested, is what would be the situation if you don't invest it.
And I think on the back of that, it is very much looking at the whole life of the building, the whole life scenario. And if you do just look through, looking at one aspect of it, you're not going to see the whole picture, and therefore you're not going to capture that whole value. You're going to say, oh, this is going to cost me, but you say, yeah, but actually you need to be looking 30 years ahead. Climate's going to change. You're going to have a building that's fit for purpose. So I think it is encouraging a sort of a TOTEX approach to the situation, and definitely we're looking more now not just at the financial appraisal, we're looking at the carbon appraisal as well alongside it to understand what we need to do to sort of future proof that particular asset.
Thanks, everyone. Really interesting. Can we have a look at the poll results then, please? Good to see that no one thinks it's not a relevant topic for lenders. Does anybody have any reflections, particularly on our lead answer, which is assets with a plan to improve their overall climate resilience? I mean, that very much chimes with what the panelists have been saying. So any further reflections on the other options?
Yeah, so I can chime in there. At the moment, across all sectors, there's the Bank of England climate stress testing going on. I think it talks to Gregor's point about asset management plans. What borrowers can expect from lenders is an increasing level of requests on disclosures of data, of strategies. What are the plans that go way beyond, just send us the list of the EPCs and stuff like that, which may have qualified 3 years ago, maybe longer ago. Unfortunately, that level of diligence is going to increase for sure. And it's heartening to see, like you say, no one's saying it doesn't matter, but also actually the EPCs is quite a low response, because yes, it's a super important thing, but the topic is so much more than just the EPC ratings.
And I guess, David, from my perspective as someone who's trying to make policy in this space, I've been in my role 2.5 years now, and the rate of change of ambition from government has been huge, which is great. It's brilliant, but it does make it quite difficult to make policy in the space when the rate of change of ambition is sort of accelerating away from you, because making good policy takes time, consultations, need legislation. So it's all very positive, but it's also quite difficult, I think, and we'll come on to that perhaps a bit later with questions around the role of government. Just in a plug for my own piece of work. So in terms of industry agreed standards, this is perhaps something that's more important at the smaller end of the market, so for SME buildings. But we've actually worked with the British Standards Institute to create something called PAS 2038, which is a kind of industry-led group who've developed a kind of best practice standard for retrofit. So that's something that it's a voluntary standard at the moment, but should provide kind of consumer assurance that if they do have work done to those standards, it should be top class work, and also help to address the performance gap, because it talks about that kind of medium-term plan for retrofitting and not a sort of measure by measure approach, which we know doesn't always kind of give the outcomes that you might expect. Does anyone else have any reflections on the poll?
Just a point to say, in our experience with lenders currently, just positively, there's much more focus on our overall approach to ESG, and very much on the G as well, the governance behind it. And I think that's got to be a really major step forward for sustainability, in terms of having the correct governance within organisations to be able to embed sustainability in the high level financial decision making of a business. Because if you don't have good governance, then it's very difficult to follow through with your environmental and sustainability aspirations. So again, very positively, the way that the task force on climate related financial disclosure is working, and the obligations of the financial institutions to report is then pushing down on companies such as ourselves to show our actions, show our plan. So I see that as very positive, because it means we have to get our story together. We know what we're doing, but we have to put the story together in a more comprehensive way to show that you do have a plan and we're organised. So I think that can only help to really embed sustainability, rather than it being, oh, this is the fluffy tack on, the other project on the side that we want to do. As Gregor was saying, we need mainstreams of financing for these projects, which it's not either or. It's all about, yes, we do that, but this is also a bona fide stream of funding to make sure that we can decarbonise at the same time, and we're not having to compromise on our priorities because we want to do it. We can hopefully do both at the same time.
Thanks, Joe. We've got a really good question from the audience, which I think kind of plays to this point about having a plan. I think someone might be showing their age slightly in the question. So it says, how do we avoid the Betamax video risk given technology is evolving and in some areas nascent? Is there a risk we wait to see what happens to avoid wasted capital expenditure and obsolete tech? So I guess this is sort of, how are people getting their heads around, the picture now, given it's so fast evolving versus where we might be technology wise in 10, 15 years time, maybe? Because I myself suffer from going between, oh my God, 2050 is not that far away, to, oh, actually, we've got quite a lot of time. And I feel that in my policy making. So good to get reflections on that particular question.
I think you can go around in circles on that one. But definitely, I in terms of looking at what's here and now for the next 5 years, if we look at, our science-based target is for 2030, and really we have to look at the technology that is deliverable in the next 5 to 10 years. Yes, we are looking ahead beyond that, but it has to be here and now to be able to implement it here and now. And so yes, you can twist yourself in circles about unintended consequences of the technology you're putting in now and what that's going to look like and how we're going to recycle PVs in 25 years time and all of that. But what it has to come back down to is the real changes now. The changes that we can make now have much higher value for decarbonisation, and it will certainly be cheaper if you do it now than it will be in 20 years.
I agree. I think it's about mitigating risks at the end of the day. I think, you have the technology available today and you can test it and you can sort of try to get the technology in terms of perhaps, solar panels that are more performant today as much as you can. And you don't know, how that's going to evolve in the next 5 years. But what you will know is that your asset will be stranded if you don't do anything today in 5 years. And so it's really about mitigating that risk and future-proofing it, and with the technology available today, making sure that you're, doing your proper research in terms of how performant it is and what it's available, what it's going to be able to achieve for you. Because the alternative, I think, is that there will be a brown discount on your asset if you don't.
Yeah, and all I'd add from my perspective is that, most of the literature and people speaking on the topic of climate change would say to prioritize action. So there is that risk of inertia, waiting for perfection actually doesn't lead to the outcomes that we need. So, but I would say, we need to all collaborate in ways that we haven't before, because actually when you go to academia, you go to certain aspects of consultancy, people know how to decarbonize buildings. They know what the best actionable plan is today. So I would just urge, probably action over perfection right now. But like I say, there is a lot of very good guidance out there as how best to achieve this.
Thanks, everyone. I mean, from our perspective in government, I see that regularly with, the underpinning work that our analysts do around kind of stock level look at abatement potential and where we might find these carbon savings from. And, quite regularly we get new data around, the efficiency of HVAC or something similar to that kind of has to be built into our modelling. And on the whole, that's all very positive. It shows us that there's more technical potential out there. There's more scope for saving carbon emissions. So, that although I can see how it could create difficult kind of choices on the ground in terms of where we're heading, that's all very positive. I've got a much broader question now, which is for lenders. So what do lenders see as the most exciting opportunities in the green space?
Okay, so I'll keep it really short. So what I'm probably most excited about is the systematic greening of real estate finance. So acknowledging that, if we're going to have a net zero economy in the future, we're going to need to move towards a net zero financial markets. That's all going to have to move over time. So what do I mean by, rather than just green finance, I'm talking about greening of finance. And what I mean by that is, at extremists, you're going to see a heightened focus on counterparty and asset level risk. And that may lead to some different risk appetites, and in extremists might lead to a lack of appetite. So I think there's that end of the spectrum to the sort of stick. But then I think transitional loans, like Gregor's stuff, and sustainability linked loans, hugely important. I think the mainstreaming of that in the right way is really important to get to where we need to get to. And finally, you know, further green loans, green bonds to sort of create that market and grow that market. So I think it's the end-to-end market. And I think new product evolution, I think someone in the chat talked about CapEx, talked about loan to value. I think what I'm excited about is that we will see further evolution over the next couple of years from a number of different capital sources, which is great and should be encouraged.
Completely agree with that, and I think it's about, and we already saw it in the answers to the previous poll coming through, where I think the lending community is moving from seeing sustainability as a risk assessment factor. So saying, you know, demonstrate you've got an EPC of X and we might make a loan, and if you can't, then we won't. That's all good and well, and it's probably prudent to do that, but it doesn't really achieve anything. And I think what we're seeing is that movement to a much more impact based. So I lend you money if you do X. You know, that is the direction of travel. And as David says, I think that's going to be the dominant form, and the notion that you can make a commercial return and achieve a societal good at the same time is going to be that's what finance should be.
In terms of adding to the societal good, I think on top of that, a really exciting area is the financing of biodiversity in the built environment. And these sorts of enhancements are often quite difficult to show, you know, return on investment. But I mean, I think especially due to the COVID and our post-pandemic situation, you know, we've seen the importance of green space in the built environment and everywhere, and access to nature and how that links to people's health and well-being. And it does feel that in terms of building the place, building the communities, that there's a fantastic potential there in the future for the financing of biodiversity in different ways, and so many other benefits in terms of the ecosystem services and you know, cooling the urban environment and everything else.
Thanks, Joe. One, I guess, for me, what should the role of government be in the decarbonisation of commercial and industrial buildings? And I guess any reflections you have on the current policy landscape that we've talked about, EPC B, the kind of our proposal to bring in performance-based ratings for large commercial industrial buildings, and of course the kind of Neighbours UK scheme that's now up and running. So reflections, please, that would be great.
Yeah, sure. Happy to kick off on that. I mean, it's you know, we've seen the direction of travel is positive, right? This is a topic which is becoming increasingly important to all stakeholders in this area. So not just the owners of buildings, the financiers, the occupiers, and so forth. So seeing clarity on guidance is and direction of travel is positive. We see you know, Neighbours as a positive step in terms of simplifying the design process, having that sort of independent design review, having the additional design documentation, having verification method, you know, post construction is all positive. But I think we also need to not overstate the importance, and I think you were right to separate the situation for owner-occupier SME type buildings as opposed to larger commercial, because I think in that larger commercial, back to the previous questions about Betamax, I think there is so much innovation going on that we just want people to kind of go ahead and act. And if the direction of travel is broadly clear, then let's go down that route. I think in other areas, you know, the resources and the capacity to work out what the right answer is on each individual property and to cost that up is more challenging. So having something which just provides a standard, I think, makes a lot of sense. But at the risk, I'm not going to try to run down the clock, but I think there are also two other areas which are really important in terms of the role of government in terms of sector, and very obviously that is the role of government as occupier. You know, it's across the various areas the largest occupier of commercial space in the country. That needs to be really a driving force, and similarly the role of government and government related entities as investors in the sector through both directly and indirectly. So I think there's very considerable force to be borne on that.
Thanks, Gregor.
I think we certainly do need to move towards a performance-based rating for existing buildings. But there are also other things that I think we should be considering and more incentives for the commercial real estate sector. For example, other large energy using sectors have climate change agreements. There's a really high level of energy use within the commercial real estate sector. Okay, we're not sort of an industrial sector, but if you put it all together, it's significant. And therefore you say, well, why shouldn't there be an incentive like the climate change agreement for the commercial real estate sector as well? And through those incentives, I think you'll see just a lot more buy-in at lots of different levels. And that can make a step change in people's in embracing the decarbonised society going forward.
Steph, I had just two bits to add to that. So in terms of things like Neighbours UK, we have a sustainable development loan programme, and certification is an important part of that to demonstrate that things are qualifying, buildings do meet required standards. So I think anything like that is useful. It won't solve everything because not everyone can afford certification or have the data available to do that. But I think just my reflections on direction is that investors are generally rational. So knowing a future direction, they can price in to say, right, I've got an asset here that's a D. I know it's going to cost Y to get to a B. I know I've got to do that by 2030. I can price it in. So I think clear mid to long term policy direction is handy for financial actors.
Yeah. And to build on that, I think the way I see it is it's really a two-pronged approach. I think on the one hand, you've got sort of, as I was saying before, investors that are really driving a lot of the ESG criteria and seeking performance because of wanting to future-proof their assets, but not just future-proof them, but really drive value. And so on the one side, I think it's a combination of market-driven competition, and then on the other hand, government's role to be transparent about what are the requirements, and to also maybe make sure that the common denominator is also something that is moving forward. And I think it's interesting in my role to see around Europe, for example, in France, there is a regulation that's requiring that all buildings coordinated with the tenants drive consumption reductions by, I think it's 40% by end of 2030, up to 60% by 2050. And obviously that's going to have a very large impact, and it's driven by legislation. So I think both of those have a very important role.
So we're coming right up to the end. I've got a very quick question that links to the point around CCAs and tax and business rates. So very quick answers, but how do panelists feel that there are tweaks to things like business rates and other taxes that would support the economics of retrofit work? Which I presume the answer is yes, but any specifics would be great. And I guess any final remarks before we draw this to a close at 11.
I think just if we're not going to have anything, I think on my travels we do hear things like some of the VAT treatment of some of the interventions that help to decarbonise. We do hear that, and rates. I think someone put in the Q&A. Rates is a big topic, but it goes back to that carrot and stick. How can we incentivise and help different actors to focus on decarbonisation?
And I guess as final remarks before I think we're due to wrap up, we are definitely talking to the Treasury around tax, business rates, VAT, etc. So we're doing our best. But also I just want to say, obviously, thank you very much for your time today, everyone, both the panelists and the people attending. We've had great numbers. We've collected the Q&A, so we will have a look at those. And I think the recording will be available for people to watch back and to share as well. I don't think I've got anything to add unless anyone has any final remarks.
Thank you.
Brilliant. Thank you very much, everyone.
Bye.
Thank you.
Bye.
Bye.